Just in the last few moments, the BBC has confirmed that US tariffs against China add up to 145%.
In the last 30 minutes, the European Union countries has approved the bloc's first countermeasures against President Trump's tariffs, joining China and Canada in pushing back.
As skyrocketing prices and market chaos from the US-China trade war leave consumers and businesses reeling, I'm here to break down the hidden forces driving this crisis and reveal what it means for your wallet and the world. The origins of this trade war stretch back decades, rooted in a slow-burning resentment that's finally erupted. America's industrial heartland, the Rust Belt, has been bleeding for years. Once thriving towns in Ohio, Pennsylvania, and Michigan saw factories close as jobs flowed to China, where labor costs were a fraction of the US's. By 2025, the U.S. trade deficit with China stood at a colossal $300 billion annually, a gaping wound fueled by accusations of unfair practices. China's theft of intellectual property, estimated at $600 billion yearly, became a rallying cry for American policymakers who felt Beijing was gaming the system. Successive administrations, Clinton, Bush, Obama, Biden, talked tough but acted cautiously, tweaking tariffs or signing trade pacts that failed to stem the tide. Enter Donald Trump, whose 2025 return to power was a thunderclap. Campaigning on America First, he vowed to claw back jobs and punish China's economic ascent. Within days of taking office, Trump escalated tariffs on Chinese goods from 20% to a crippling 145%, a move he hailed as a lifeline for American workers. He framed it as simple justice: force China to pay for flooding U.S. markets with cheap goods. But this was no mere economic maneuver. It was a deliberate provocation. China, unbowed, vowed to fight till the end, retaliating with an 84% tariff on U.S. exports, from soybeans to tech components. Beijing's leaders see the U.S. moves as an attempt to strangle their rise, a superpower flexing its muscle to keep China down. The stakes are existential. The U.S. fears losing its economic crown, while China's Communist Party views survival as non-negotiable after centuries of resilience. What's driving this escalation? For the US, it's not just jobs. It's China's grip on 70% of rare earth minerals, critical for everything from iPhones to missiles. It's Beijing's tech leaps. Think Huawei's 5G dominance and AI breakthroughs. It's the specter of China's military buildup, with $246 billion in defense spending dwarfing most nations. For China, it's about dignity and sovereignty, rejecting what they call American blackmail. This isn't just a trade war, it's a battle for the soul of the 21st century. The economic carnage is staggering, a whirlwind tearing through global markets with merciless force. Wall Street is hemorrhaging wealth. In the first week of April 2025, the Dow Jones and S&P 500 plunged 7% and 9% respectively, vaporizing $2.5 trillion in market value. Blue-chip giants like Goldman Sachs, Chevron, and Apple saw share prices collapse 15 to 25%, caught in the tariff crossfire. The bond market, a gauge of investor confidence, is in chaos. 10-year Treasury yields soared to 4.34%, a level signaling deep distrust and stability. Across the Pacific, China's markets are reeling too. The CSI 300 index tanked 7%, reflecting fears over China's $450 billion export market to the U.S., 15% of its total exports, facing ruin. China's economy, valued at $18 trillion and growing at 4.7%, is resilient but not invincible. Factories in Guangdong and Shenzhen reported 75,000 layoffs in Q1 2025 as orders dried up, a human toll behind the numbers. Consumers are the silent victims. In the U.S., tariffs act like a stealth tax, poised to jack up prices for everyday goods. Electronics, clothing, and cars could cost 25 to 35% more, hammering households grappling with 3.2% inflation. A single mother in Ohio might pay $200 extra for a laptop. A family in Texas could see car repairs jump $500. In China, urban middle-class families face shrinking job prospects. Shanghai's unemployment ticked up to 5.5%, a 5-year high. Yet both nations double down. The U.S. claims tariffs will revive manufacturing, projecting 500,000 new jobs by 2027. China counters by pivoting to new markets, with ASEAN trade rising 20% since 2024. But the collateral damage is undeniable. Global trade volumes are projected to shrink 1%, per the World Trade Organization, as supply chains choke. This is economic warfare, and the body count is rising. This trade war isn't fought on spreadsheets alone. It's a geopolitical cage match, with the world as the arena. The U.S. wields unmatched economic might, with a $25.5 trillion GDP and per capita wealth of $83,000, dwarfing China's $12,500. Its dollar remains the world's reserve currency, giving Washington leverage to dictate terms. But China's no underdog. Its $18 trillion economy grows faster, 4.7% versus the U.S.'s 2.5%, and its Belt and Road Initiative has poured $1 trillion into 140 countries, buying influence from Africa to Southeast Asia. Trump's playbook is coercion. He's pressuring allies to shun China, claiming 75 nations are begging for U.S. trade deals. His pause on some tariffs, a brief nod to market panic, only underscores his control, a kingpin doling out reprieves. But allies are wavering. The EU, skeptical of U.S. flip-flopping, suspended steel tariff retaliation for just 90 days and is now racing toward a China-EU investment deal, with talks intensifying in March 2025. Germany and France, eyeing China's $400 billion consumer market, are hedging bets. The UK and Australia, torn between loyalty and profit, sent trade envoys to Beijing, signaling a crack in the Western Front. China's response blends defiance with cunning. Foreign Ministry spokesperson Mao Ning channeled Mao Zedong's Korean War grit, vowing to outlast America. State media floods platforms like X with propaganda, dismissing tariff fears as Western hysteria. Yet quietly, China's courting the EU, Africa, and Latin America, offering trade sweeteners. A $50 billion investment package for ASEAN was unveiled in April 2025. Beijing's 70% chokehold on rare earths is a trump card, threatening to starve U.S. tech and defense firms of critical inputs. This is a global loyalty test. The U.S. bets on fear and firepower, China on patience and partnerships. Neither can afford to lose face, but the world's watching, wary of picking the wrong side. In Beijing, the mood swings from pride to panic. Victor Gao, a Chinese globalization expert, is defiant. The U.S. is sabotaging itself. China will outlast this madness. He points to China's 5,000-year history, arguing it can thrive without America's 15% export share. But in Guangzhou, factory owner Wei tells a different story. My U.S. orders fell 50%, he says, eyes weary. I've cut shifts. 200 workers are gone. His family business, built over 20 years, teeters on collapse. Wall Street's take is grim. One man's whims are torching trillions, says a Morgan Stanley trader, anonymously fearing backlash. Goldman Sachs warns of a recession risk by Q4 2025. Republican strategist Lance Trover counters with populist zeal. Middle America's been crushed by China's cheats. Tariffs are justice. He cites 200,000 manufacturing jobs added since 2024. But Peter Loge, a former Obama aide, sees disaster. Tariffs are a tax on Americans. Prices will soar, and global trust in us is crumbling. He points to bond yields hitting 5%, a sign of eroding faith. These voices, worker, exec, analyst, patriot, reveal a fractured world, united only by uncertainty and fear of what's next. The U.S.-China feud is a tsunami, crashing far beyond their shores. The EU, with an $18 trillion economy, is trapped in a bind. Align with the U.S., and China could slap tariffs on $200 billion in German cars and French wine. Pivot to Beijing, and Washington's wrath looms. Germany's BMW warned of €1 billion in losses if tariffs escalate, while France's Airbus eyes China's aviation market nervously. The EU's temporary tariff truce with the U.S., 90 days expiring July 2025, is a stalling tactic, not a fix. Developing nations are collateral damage. Africa's $300 billion in Chinese Belt and Road loans, think Kenya's railways or Nigeria's ports, faces default risks if China's economy stumbles. Ethiopia's textile sector, tied to Chinese exports, shed 10,000 jobs in the first quarter of 2025. In Latin America, Brazil's $70 billion soy exports to China could tank if tariffs disrupt demand, while Chile's copper trade braces for a $15 billion hit. Global trade hubs feel the squeeze. Singapore's port, handling 37 million containers yearly, saw costs jump 30%, strangling supply chains. South Korea, caught between U.S. alliances and Chinese markets, faces a 5% GDP growth cut, per Seoul's central bank. The IMF slashed global GDP forecasts to 2.5% for 2025, down from 3%, blaming tariff chaos. This isn't a two-player game, it's a global wrecking ball. Trump's tariff gamble rests on a seductive promise: make America build again. By jacking up Chinese import costs, he aims to revive U.S. manufacturing, dormant since its 11% GDP share in 2025, down from 30% in 1970. The pitch is bold: create 1 million jobs by 2028, from steel to semiconductors. Supporters point to early wins. Pittsburgh's steel output rose 10% since tariffs kicked in, hiring 5,000 workers. But the math is brutal. China produces 50% of global goods at costs the U.S. can't match. Think $5 an hour wages versus $30 stateside. Rebuilding factories demands billions in infrastructure, retrained workers, and years. The U.S. lacks 500,000 skilled machinists per trade groups. Tariffs inflate costs not just for China but for allies like Taiwan, whose chips drive 60% of U.S. tech. An iPhone made in America would cost $2,500, says MIT, versus $1,200 now. History screams caution. The 1930s Smoot-Hawley tariffs triggered a 66% global trade collapse, deepening the Great Depression. Today's stakes dwarf that era. Goldman Sachs projects a 2% U.S. GDP drop if tariffs persist, with China's growth slowing to 3%. An AI-generated video went viral, showing Trump and allies as Chinese factory workers, asking, "Do Americans want these jobs? At these wages?" The answer's unclear, but the pain is certain. Tariffs are a blunt axe, effective until they backfire. The trade war's shockwaves aren't just rattling stocks, they're upending currencies, with the US dollar caught in a brutal squeeze. The greenback hit a 10-year low against the Swiss franc in April 2025, a stark sign of investor panic as the US-China tariff slugfest intensifies. While President Trump's 90-day tariff pause on many nations sparked a fleeting market rally, his escalation of Chinese tariffs to 145%, piled on top of Beijing's 84% retaliatory duties, has reignited fears of a global economic meltdown. Investors are fleeing to safety, pouring money into safe haven currencies like the yen and Swiss franc, which surged 2% and 3.5% against the dollar since early April. Gold smashed records, soaring past $3,200 an ounce, as traders bet on chaos over stability. The Australian dollar, a barometer for Chinese market health, tells a grimmer story. It slumped to a 5-year low of 0.5910 before clawing back to 0.6211, whipsawed by trade war jitters. China's yuan is under siege, sliding to an all-time low of 7.4288 offshore before stabilizing at 7.3545. Beijing's central bank, cutting yuan guidance for 6 straight sessions, signals a controlled depreciation to cushion export losses. China's $450 billion U.S. market is at stake, 15% of its trade. But this isn't just numbers on a screen. A weaker yuan spikes import costs, hitting Chinese consumers with pricier oil and food, while U.S. shoppers face 20 to 30% price hikes on everything from sneakers to smartphones due to tariffs. The U.S. dollar's woes reflect deeper wounds. Treasury yields dropped to 4.376% after a solid bond auction. But that's cold comfort when markets distrust U.S. policy. Trump's flip-flops, slashing tariffs one day, doubling down on China the next, have eroded faith. Analysts warn of a crisis of confidence with Deutsche Bank flagging risks of disorderly capital flows if the dollar's dominance wanes. The euro and pound rallied, up 2.47% and 1.13%, as Europe pauses countermeasures. But the relief is shaky. The EU's 90-day tariff truce is a band-aid, not a cure. This currency chaos is a trade war's hidden blade, cutting into economies far beyond Wall Street or Shanghai. From Tokyo's exporters to Berlin's bankers, the world's recalculating risks, and the dollar's throne is wobbling. The trade war's hammer is slamming America's auto industry, threatening to grind a $1 trillion sector to a halt. Trump's 25% tariffs on imported cars and parts, layered atop the 145% duties on Chinese goods, could cost U.S. automakers a staggering $108 billion, according to a 2025 industry study. This isn't just a tax on foreign competitors. It's a wrecking ball for Detroit's giants, from Ford to GM, who rely on global supply chains like oxygen. Tariffs are a tax on American consumers, plain and simple. The average U.S. car price, already $48,000, could leap 15 to 20%, adding $7,000 to a family sedan sticker. That's a gut punch for middle-class buyers, already stretched by 3.2% inflation. Used car prices, a lifeline for low-income households, are projected to spike 25% as supply chains choke and inventories shrink. Pickup trucks, America's top sellers, face the worst hit. 70% of their parts cross borders, from Mexican steel to Canadian engines. China's role is pivotal. Beijing supplies 30% of U.S. auto electronics, from chips to batteries, and tariffs are strangling this flow. U.S. firms like Tesla, with supply chains tied to Chinese lithium, are reeling. Tesla's stock dropped 7.6% in April 2025, battered by trade fears and boycotts tied to its CEO's politics. Meanwhile, China's EV giants like BYD are eyeing Europe and ASEAN, sidestepping U.S. markets while flooding global competitors with cheap models. China's auto exports to the EU jumped 40% since 2024, a middle finger to U.S. pressure. The ripple effects are merciless. U.S. auto dealers face $50 billion in losses, with 10,000 layoffs looming as showrooms empty. Mexico and Canada, hit by 25% USMCA tariffs, are retaliating. Canada's threatened 10% duties on U.S. vehicles could slash Detroit's exports by $20 billion. Even allies like Japan, slapped with 24% tariffs, are rethinking investments. Toyota's $10 billion plant expansion is on hold. Can tariffs revive U.S. auto jobs? The White House claims 200,000 new jobs by 2027, but history's skeptical. Tariffs in 2018 raised steel costs, killing 40,000 U.S. jobs in related sectors. Building cars stateside is a pipe dream when China's factories churn out EVs for $15,000 versus $50,000 in Michigan. This is an industry on life support, and tariffs might just pull the plug. The U.S.-China trade war isn't just a policy dispute. It's a seismic struggle for the future. Two superpowers, commanding $43 trillion in GDP, are betting their economies on pride and power. The cost? Trillions in wealth, millions of jobs, and a fractured global order. Ordinary people, American shoppers, Chinese workers, African farmers, bear the brunt. As markets gyrate and diplomats scramble, one truth stands out. No one wins in a trade war. Can cooler heads prevail, or are we hurtling toward economic Armageddon? Share your thoughts below, and subscribe for updates on this unfolding crisis. The world's watching, and so should you. As skyrocketing prices and market chaos from the U.S.-China trade war leave consumers and businesses reeling, I'm here to break down the hidden forces driving this crisis and reveal what it means for your wallet and the world. The origins of this trade war stretch back decades, rooted in a slow-burning resentment that's finally erupted. America's industrial heartland, the Rust Belt, has been bleeding for years. Once thriving towns in Ohio, Pennsylvania, and Michigan saw factories close as jobs flowed to China, where labor costs were a fraction of the U.S.'s. By 2025, the U.S. trade deficit with China stood at a colossal $300 billion annually. a gaping wound fueled by accusations of unfair practices. China's theft of intellectual property, estimated at $600 billion yearly, became a rallying cry for American policymakers who felt Beijing was gaming the system. Successive